Good afternoon and welcome to today's Thought Leader webinar with our guest speaker, Viktor Shvets. Viktor is a Managing Director and Head of Asia Pacific and Global Strategy at Macquarie Group based in Hong Kong. He's talking to us today in his capacity as the author of his book, The Great Rupture. And you can find the link on our website straight to the Amazon page, which profiles Viktor's book, just as an example. But as with all speakers, the views they're espousing are their views. They're not necessarily consistent with our own in-house view. I'm just going to quickly read out the general advice warning. So the information contained in this webinar has been provided as general advice only. The contents have been prepared without taking into account your objectives, financial situation or needs. You should, before you make any decision regarding any information, strategies or products mentioned in the webinar, consult your advisor to consider whether that is appropriate having regard to these objectives, financial situations and needs. I've been fortunate to work with Viktor twice in my career. So in the late 1980s, early 90s, Australia was last in recession and we both worked at Baring Securities. And Viktor and I were just talking about this time just then. He put out a report on Adelaide's steamship, which many of you would remember, that was seen at the time as very, very controversial. In Hong Kong at Deutsche Securities, Viktor and I also worked together. Where Viktor looked after airlines, media and telecommunications. And at that time, we were going through the Asia crisis. So I mentioned the last recession that was 30 years ago and the Asia crisis intentionally. Then, like now, we've come out of issues with clear winners and losers. There are clear winners and losers that have appeared and will continue to from COVID-19. Viktor in his book does explore these themes and not only the challenges that face us, but will we embrace these challenges? So I'm going to hand over now to Viktor. As always, we'll have the questions at conclusion. So please use the Q&A button in the toolbar at the bottom. So welcome and thank you, Viktor.
Well, thank you very much, Will. And I hope you all can hear me well without any interruptions or any static signal. Once again, thank you everybody for participating in this webinar, and particularly thank you to Will. As Will said, we worked together in several places over several decades, and I have always had a great deal of respect for Will. We've been colleagues and good friends for many years. The book Will is referring to was published several months ago, and the key to that book is just one sentence. Do we need to be free to be productive, to be innovative, and perhaps even happy? It sounds like a very simple question. Do you need to be free? But it's far more complex as you go through the book. What do you mean by freedom? Freedom from what? Freedom in the favor of what? And the first part of the book, which is essentially historical, goes through what happened over the last 5 centuries. And it absolutely unequivocally shows that increasing freedom, personal rights, rights to explore, to exchange information, were absolutely critical to the success of the West and led to the collapse of all non-Western civilization. The book specifically explores China, Russia, and the Ottoman empires, but pretty much the same conclusion could be reached for any non-Western civilization between 1500s and 1900s. And so history tells us we need freedom. As I said, freedom to exchange views, personal freedom, increasingly tighter and fairer and impartial property and civil rights to succeed. That is why England had industrial revolutions and Qing Empire collapsed. Russia no longer has Tsars and there is no longer Ottoman Empire. But the question is, in the modern world, in the information age, what are the recipes for success, individual success as well as national success? Is it the same as it was in the previous 5 centuries, or is the environment changing? And the message from the book is that the environment is changing drastically. It will be as different as feudalism was to the capitalism. And this time transition is much much faster. I think McKinsey is absolutely correct to highlight that information age has a waterfront about 300 times deeper than industrial revolutions, and it progresses at about 10 times the speed. So the impact of information age is at least 3,000 times the impact of industrial revolution. And remember how much change industrial revolution have brought to bear between the middle of 18th centuries and say late 20th century. So you can imagine how much our environment actually is going to change as we go forward. Now, what drives the information age? Well, one of the things I describe in the book is what I call Fujiwara impact. Fujiwara impacts are very rare. That's essentially when two hurricanes combine into one. They need to be pretty close. They need to be no more than 1,000, 1,500 kilometers apart. And sometimes it happens. Actually, about a month ago, it almost happened in the Gulf of Mexico, but it's rare. And so the way I look at Fujiwara impact, what we're seeing is convergence of two very powerful forces. One is technology. And technology is really a human spirit and human ingenuity. And the other one is financialization. And that's what we inflicted upon ourselves. That's not necessarily human spirit by such. And it's really the mixture of the two which are driving us closer and closer to the black hole. Every day, every month, every year that passes, we're getting closer. As we're getting closer, our bodies get stretched, our views of the world get stretched, our economic system stretch, and investment style change massively. And so it's quite important to identify how close you are to the black hole. But even if you're decades away, remember, black hole you can feel, apparently, I haven't experienced myself, but you can apparently feel it like a couple of 100 years away. And so the important thing is to say we're getting closer to it. And so the book is asking a question: what lies on the other side of the black hole? And the answer to us, it's definitely not liberal capitalism. It could be another version of capitalism. It could be communism. It could be feudalism. It could be despotism. But it's not going to be what we have experienced over the last several hundred years. And what the book is describing, and one of the things, if one wants to take just one page out of the book, that's going to be page 161 in table 10. In one table, in my view, it summarizes the key differences between industrial age and the information age. Both of them were born in 1971. That's where Richard Nixon abolished the gold standard and basically created fiat currencies. That was the beginning of financialization. And 1971 is also the year when information age was born. This is your personal computers. This is your silicons. Most of the things you take for granted today were born around 1971. So that was your beginning. We now have progressed over 5 decades, and we can see the differences between the two eras quite clearly. The first thing to highlight is that industrial age had limitation on capital. In other words, capital was limited, it was scarce, it needed to be carefully husbanded, carefully deployed. That's why we've developed accounting systems. That's why we've developed discounted cash flow models, capital asset pricing models, in order to decide what is the most optimal way of allocating and deploying capital. Information age, however, is totally different. We live in a world of abundance of capital. In fact, we're drowning in capital. We don't even know what to do with it. And that's a legacy of the merger of financialization and technology. We've been growing money supply for the last 40 years, at least 3 times faster than nominal GDP. The differences between those two lines are essentially asset prices. That is your pension portfolios. That is your houses that you live in. That's any asset class. And so what we've created too much capital. We've been creating every year more capital than we require. As a result, the leverage globally is anywhere from 3 to 4 to 1. If you go back to 50s, 60s, and 70s, we only needed $1, $1.50 of debt for every dollar of GDP. Today, we need between $3 to $5 of debt for every dollar of GDP. If you think of financialization, value of all financial instruments outstanding, it's anywhere from 5 to 10 times global GDP. So there is plenty of capital, more than ever in the history of human existence. It might not be fairly distributed. It might not be evenly distributed, but there is plenty of capital available. And as we continue to generate more capital than we require, cost of capital inevitably continues to collapse. And a collapsing cost of capital has many implications. It's got implications for financial markets. It's got implications for inflation or disinflation. It's got implications for income and wealth inequalities. So that's the first big difference. Industrial age, essentially capital was scarce, needed to be allocated in a very careful manner. Today, we are suffering from excess capital, and capital gradually is becoming worthless. The second big difference, how we use capital. 19th and 20th century was all about capital intensity. It's about railroads, it's about factories, it's about machinery. Today, however, almost all the new businesses are relatively capital light. They don't require as much capital anymore. And increasingly, it is as capital light businesses and capital light business models that are driving growth rates, are driving wealth, are driving pretty much all outcomes. If you think of intangible assets as a percentage of private sector GDP, in the US, it's already 50 to 60%. It's between 35 to 45% in the UK or France. It's about 35% in Japan. Even in China, it's about 10 to 20%. So effectively, the new businesses do not require much capital. And not only they don't require much capital, but at the same time, they eat tangible assets. They effectively destroy and consume, whether it's factories, whether it's roads, whether it's human beings. So that's the second biggest difference. We don't need as much capital as the capital we are creating. And so you reach the stage by arguing, what is capital? What should it be worth? How should one value? For example, if one assumes that risk-free rates are close to zero and equity risk premiums are close to zero, then valuations become almost infinite by definition. And as cost of capital continues to drop, what happens is that every project becomes viable, and everybody is bidding for every project. At that point in time, returns on the projects decline. As the returns decline, cost of equity capital has to fall even more to compensate for it, which means bidding for new projects increases even more, and then cost of equity capital has to fall even further. Eventually, the answer is zero, both for returns and cost of capital. So when you reach the stage that it's not clear what is the cost of capital, if anything, that is no longer capitalism. The other major difference is labor and human inputs. Through 19th and 20th century, labor was a critical productivity driver. That is why we needed to eliminate illiteracy. That is why gradually, bit by bit, we progressed higher in education and skilling. Labor had to be trained to work with machines more and more. And as machines were improving, we needed to specialize more and more in order to be the brains of those machines. Increasingly, what we're seeing is that humans are no longer the key productivity drivers. Humans increasingly play smaller and smaller role, either in terms of the cost of the products and services that we produce and market, or in terms of productivity that they can actually deliver. So 19th, 20th century was all about college premiums, for example. The higher your education, the higher the premium you were getting. The last 10 years saw a significant decline in the college premiums. It's no longer true that college education will deliver you either wages or productivity premiums. So what is going on? Well, what is going on is that we live in a world of declining marginal utility and marginal contribution of labor and a marginal pricing power of labor. Essentially, technology progressed far enough to reduce our usefulness, but not far enough to replace us altogether. As a late professor at LSE once described it, we're creating bullshit jobs. And what he meant by that, even people performing those functions no longer believe that they add much value, if anything, that is actually going on. In some of the surveys he conducted, up to 40–50% of white-collar employees across Europe did not believe that they had much value and that they had less value than they used to in a prior decades. So what's going on? We're getting disintermediated from productivity. We're getting disintermediated from fruits of our labor. And every day that you sit in your chair, your marginal productivity and your marginal pricing power declines. That's why you're not even asking for higher wages, even when unemployment levels are incredibly high, because you know that you don't deserve higher wages. You don't contribute as much as you used to in the past. So it's a radically different world. Again, it started in the early 70s, but really accelerated in 90s. It essentially started with mostly vice president and middle management when technology and the first IT companies came through. Then it progressed to entertainers, to thinkers. Then it progressed on to journalists. Then it was traders. Now increasingly it's progressing where analysts and fund managers are residing. And it's going away from purely digits to atoms. Increasingly, we're starting to disintermediate atoms. Now, that will impact manufacturing, that will impact logistics, that will impact house constructions, that will impact how we trade, how we produce, how we distribute. Whether you're a plumber, whether you're a construction worker, whether you're a truck driver, in the next 10 years, you will feel exactly the same impact what entertainers or journalists have felt over the last several decades. Beyond atoms, of course, lies singularity. And that is essentially when you satisfy Turing test. And under the Turing test, essentially you can't tell the difference between human and non-human contribution. Now, it does lie several decades out. But again, remember my black hole comparison. We don't need to be right at the event frontier to feel its impact. We're feeling it already. And that feeling of uselessness, that feeling of irrelevance, will become stronger and stronger over the next 5–10 years. At a singularity, we could then question, why do we need a PhDs in computer science? Why do we need a lot of other higher value of higher cognitive functions, occupations? So labor doesn't function the same way as in a liberal capitalist society. When the idea was that you combine capital with labor, you train labor to a higher and higher level, and that will start generating higher productivity and higher growth rates. What we now have is that we don't need as much capital. Increasingly, economies are becoming lighter. Increasingly, they're driven by intangible assets. And intangible assets don't have capacity limitations that tangible assets do. You can multiply intangibles millions of times without any degrading. If you run out of capacity in your Coca-Cola bottling plant, you need to build another one. So it doesn't have the same capacity limitations. It also offers spillover effects. One industry can suddenly spill over very quickly into another industry. And so capital is changing. How we use capital is changing. How we use labor is changing. So none of that resembles 19th or 20th century. And all of them requires a very, very different policies. Now, what would the future look like? Well, one of the things the book brings up is a question whether in fact freedom is now significantly overrated. An example we provide is one of Nikolai Bukharin. He was a Soviet Bolshevik. In 1920–21, when the Bolsheviks got control of the country, they had the Mao moment, eliminating money, running around with little books. So they've done all of that. Economy collapsed. And so Lenin recognized that unless they do something, people will simply kick them out. And so he entrusted a young guy by the name of Nikolai Bukharin to build a different economic model. When people say, hey, the communists don't understand economics, that is not correct. They do. But their view was, at the time, that combining state planning with some degree of personal freedom will create a better asset allocation than Adam Smith's invisible hand. And so Bukharin in 1920 deregulated peasants, agriculture, small and medium-sized enterprises. He kept control of the commanding heights of the economy for the government. He controlled a lot of prices, a lot of inputs. Initially, it was a great success, but then it collapsed because he simply could not determine what demand is. Signals were not correct. Signals cannot be assessed. And so eventually the system collapsed. And the Soviet Union reverted back to a more traditional communist model. And of course, Bukharin was shot by Stalin in 1937. In 1980s, Deng Xiaoping resurrected pretty much Bukharin model. But he's gone way beyond where Bukharin even intended to go. And the question that the book raises, whether it's a Bukharin experiment, whether it's Deng Xiaoping experiment, whether it's Salvador Allende in Chile, who tried something similar in the early 1970s, whether it's socialist calculation debate, which raged in 1920s, 30s, and 40s around the world, whether state planning or Adam Smith's invisible hand are better, all of that is coming back. Maybe Bukharin was right. He was just 100 years ahead of his time. And Xi Jinping, the leader of China, genuinely believes that he's got now a computational capability to generate signals that are superior to free market. Now, I happen to believe that that might be true. And as technology evolves, that will become more and more true as we progress forward, that the computational capability will be there. So in other words, central planning, for all its bad reputation, could be coming back, and it might not suffer from the stagnation of ideas or outcomes, the way Soviet Union has suffered, or the way early experiments in China have suffered. So that's one example how system could change. The other example is education, skilling, innovation. So for example, China is incredibly innovative, but it's not inventive. There is a huge difference between the two. Inventiveness, it's something new. Innovation is basically adapting what was already proven to be correct, at least in the realms of science. So Google did not invent anything. Apple have not invented anything, but they're incredibly good innovators. So if you think of why we invent, that's your freedom. Freedom to exchange ideas, freedom to debate, freedom to disagree. That is why inventiveness progressed so much. That's why even today, over 90% of the bank of inventiveness belongs to the West, not to China, not to Korea, not to India, not to anybody else, to the West. And so the question becomes, in the new world, how important is it to be free? And the argument is the same computational capability, the same artificial intelligence, increasingly starting to encroach into the area of inventiveness. It will take decades before flexibility of human mind can ever be replicated. It's going to take a long time. But increasingly what we're seeing, that is starting to happen. And so if in fact it's non-human, or at least artificial intelligence significantly enhances inventiveness, how important is it to allow professors at Beijing universities to exchange views? How important it is for them to debate? Maybe we're overstating the importance of that. And that's just two examples, central planning, inventiveness, where the prerequisites of free economic signals and a freedom to explore created the West, made it so successful. And those two key planks might not necessarily play exactly the same role. So the question then becomes, okay, if we want to keep some degree of freedom, how can we do that? In other words, it seems like we can create highly illiberal, and one would argue brutal societies that no longer suffers from stagnation of ideas, inventiveness, or wealth. So how can we protect ourselves? Well, what the book discusses is some of the policies that must be deployed. The first policy is basic or universal income guarantee. When people say, hey, that is just giveaways, that's creating lazy people, that's incorrect. Because the question I usually ask, what is the alternative? We're living in the world of declining marginal utility and declining marginal contribution of labor. What basic income guarantee is designed to do is basically take the sting out of the Maslowian disappointment. As people become more and more disappointed with their life and what they do, basic income guarantee basically removes at least some of those extreme emotion out of the social or geopolitical dislocation. It basically tries to attack a very important point, that our major concern going forward is not exploitation, it's not inequality, but irrelevance, which simply will become irrelevant. And so basic income guarantee will provide you with an opportunity to build a different life. And have different interests. There are many issues that we discuss in the book that are important. How do we build satisfaction if it's not through jobs? Because jobs will no longer be there anyway. It's not through jobs. It's not through success. It's not through money. How do you make people comfortable? Is it going to be religion? Is it going to be sports? Is it going to be personal interaction? So there is a whole range of issues there. But basic income guarantee is one of the planks, the major plank actually, trying to reconcile the future with today. Another plank to mind is clearly regulatory structures and anti-competitive behavior structures. That particularly applies to the big tech. And that's essentially highlighting that we ourselves are now a product. We're not consumers, we're users. And so you need to create a system which recognize that anti-competitive behavior, it's not hurting people financially. It's hurting people in other ways. In fact, big tech reduces cost. So it's not so much that you financially suffer. So the new regulations have to recognize that we are the product. And how do you want to regulate this product? How do you regulate social interactions? How do you regulate electoral interactions? Where in fact, artificial intelligence essentially curates whatever we do and whatever we see. It also should allow competition to prosper, because platforms have a capacity to create monopolies and very high returns incredibly fast. So how do you actually encourage competition? So that's the second plank. The third plank, to my mind, is education and skilling. One of the things I argued in my book is that by 2040s, it is quite possible that Harvard College will be closed for lack of demand. And what I mean by that, how we get educated, how we get skilled, what we learn, how we learn it, where we learn it, all is going to change as we go forward. It's not about creation of very specialized talents. It's about creating human beings. Because in a world of irrelevancy, the only thing that remains relevant is our humanity. And so you need to rebuild those institutions. Bachelor degrees should disappear altogether unless you want to pursue academic career. It should be rapid change of certificates, styles. One day you're learning cooking, the next it's IT, the next it's games, the next is something else. So changing education and skilling system is incredibly important. And the fourth major plank is what I argue is a massive Marshall Plan for least developed economies in the world. Not because we can get return out of it financially. The most important thing is that these are the places that will create social dislocation, immigration dislocation, geopolitical pressures, and a healthcare and pandemics. So that's our return. Rather than necessarily saying, can we get paid on the money that we have provided? Just like the original Marshall Plan has never been repaid, the new Marshall Plan will be the same. Now, to do all of that, we also need to change our policies. And that's where you go into the argument of modern monetary theory and fiscal policies. That private sector no longer functions the way it used to. Corporates no longer function the way they used to. Private sector primacy is finished. It's never going to come back. Private sector will never be able to grow and deliver the type of growth rates that society as a whole demands. So public sector increasingly starting to understand that they are responsible to satisfy societal expectations. Over the first 3 to 4 decades, it was essentially through monetary means. But if you just use monetary levers, it becomes incredibly toxic. If you continuously generate more capital than you need, as I said, cost of capital goes down drastically. Eventually, interest rates will be negative everywhere around the world. You create disinflation rather than creating inflation. You narrow growth opportunities, both in economies as well as in the companies. You create massive income and wealth inequalities. You're creating social and geopolitical tension. So just using monetary levers eventually becomes incredibly toxic. And it has already been toxic for at least the last 5 to 10 years. And so we need to switch policy tools. And the alternative public policy tools is fiscal. And so the question that becomes how you fund it, and the answer is MMT. You fund it without generating debt. Now, a lot of people say, but governments misallocate capital. To those people, I say, do you think private sector allocated capital correctly over the last couple of decades? Do you think private sector allocated correctly in 1920s? Yes, public sector can misallocate, as it did in late 60s and 70s, but it doesn't mean necessarily that always public sector is inferior. And besides, we have so much capital that capital is becoming almost worthless. So to me, what public sector can do is instead of leaving money in a cloud of finance and very little of it gets to the ground, is directed exactly to the ground where people belong. And we already know what the government will be spending on. It's going to be basic income guarantees. It's going to be community supports. It's going to be consumption supports. It's going to be education and skilling. It's going to be basic R&D. It's going to be pharmaceutical spending. It's going to be infrastructure. So we already know what they're going to do. Part of the private sector will get nationalized completely. In particular, capital markets must be. But the rest of the private sector will still be there. It will be just co-opted into various things that the public sector is going to do. So in order to achieve all of those objectives, what public sector does and how they do it and how they get funded to do it becomes a critical point of debate. And 10 years ago, if anybody said what I've just said, that said it's a complete fringe. It's amazing how much people have progressed over the last 10 years. And the same way as Black Monday and .com and global financial crisis accelerated monetary policies, COVID-19 is essentially accelerating that view of the state and that view of the public sector. The other thing that is accelerating public sector role is clearly the generational change. Baby boomers and X generation, essentially anybody born, say, earlier than mid-1970s, they believe in freedom, choice, efficiency. They created a world where you can marry anybody you want, you can divorce anybody you want, you can travel anywhere you like, you can change your jobs, you can change your country. It was all about opportunity, not about fairness. It's about opportunity. Now, the toxic effect of baby boomers' world is here for everybody to see. It results in massive inequalities, environmental degradation. It creates disinflationary pressures. We all can see the negative impact. The new millennial and Z generation, sort of anybody born kind of from mid-1980s onwards, are very, very different. They grow up in a world where college education is no longer bestowing the same premiums. They grow up in time when jobs are getting disintermediated. Up to 20-25% of jobs now in the world are gig or gig related. There is no such thing as job or profession pretty much anymore. And that's going to get even worse in the next 5 to 10 years. They grew up during wars, whether it's Iraq War, Afghanistan, national security, homeland security. They grew up during financial crises. And many other crises. And so they're much more similar to their grandparents, to the silent generation, who grew up through hyperinflations, depressions, wars. And just like silent generation appreciated the government's role, appreciated that you must give up some freedoms for it. Just like their generation wanted equality and fairness. New generation is very similar. They want equality, they want fairness. They don't necessarily want opportunity. They don't necessarily want freedom or choice. They're actually quite prepared to sacrifice some freedom. Now, today in most developed countries, these new generations are about 35% of the electorate to 40% of the electorate. Very soon there will be a majority. And when they are, those kind of state-related policies will accelerate just like they did from late 1940s. Until well into 1970s. So it's not only technology and financializations which are driving us there. I think generational change also are driving us there. Now, how do you invest in that climate? Well, one of the things we keep highlighting, if risk-free rate is zero, equity risk premium is zero, valuation is infinite. And whenever cost of capital goes very low, funny things happen. And what essentially happens, there is a dispersion of multiples increases. Instead of being just 1 or 2 standard deviation from the mean, it could be 5 or 6. It massively diverges. And essentially any company that can defy growth limitations, disinflation limitation, and somehow grow becomes almost infinitely expensive. And the same infinity company that suddenly stumbles and somehow doesn't know where to go forward becomes almost instantaneously infinitely cheap. But a normal company that just does a good thing, has a good balance sheet, good roads and factories and the rest of it, just gets cheaper. And it will continue to get cheaper as we go forward. And that's your essence of growth versus value style investment. That the world of financialization, the world of information age and technology is a world of no mean reversion. Nobody wants to mean revert. Every time you ask people, would you like to go to liberal capitalism? People say, yes, that's a good idea. And when you mention, but you know, it might imply that your houses are not worth what you paid for them. Are you okay with that? People say, no, I'm not okay with that. Do you recognize that a lot of factories need to close? No, I'm not okay. Do you recognize 15% of our companies are zombies now? No, I'm not happy with that. So nobody wants to mean revert. People don't want to do it. Politics don't want to do it. Regulators don't want to do it. So mean reversion is not possible. And the essence of mean reversion is value and value style investment. So it's not to say value cannot run up. It can. And MMT policies, when they implement it, will actually give some value stocks longer runway. But at the end of the day, intangibles will continue eating tangibles like a black hole. They'll just keep on sucking it out. And so inevitably, those intangibly driven companies will get bigger and bigger. And by the way, it doesn't have to be technology. It's any company that is using technology or data differently. It could be Nike. It could be Hermes. It could be Ferrari. It could be Visa. It doesn't have to be pure tech. It's anybody who is using technology differently. And those companies will continue to accelerate at a faster pace than a frontier. OECD estimated back in 2015 that 5% of every sector in the world, industrial sector in the world, is accelerating productivity 3-4 times faster than frontier, much faster than it used to be in 1980s. In 1990s. And that's the essence. It's how you use technology, how you use what you have that matters. And if you stumble, you stumble. And then you derate it mercilessly. So to me, it's still very much the world of growth and particularly the world of thematics. And you have to be careful what type of thematics you choose. Some thematics actually make sense. A lot of other thematics do not. And before I go, just one more point. Corporates themselves are dying. The whole idea of having a corporate is actually a decline in transaction cost. If technology reduces transaction cost to zero, and if capital is almost free, why do you need corporates at all? Why do you need corporates surviving for 50, 100 years? So I think the future increasingly will be flashes in the sky. Guys will get together, they will change a few things, they will flare up for 6, 12 months and they go away. And the new things flare up. So corporates are changing, what corporates do is changing. So it's going to be quite an interesting world to invest in. I'll leave it there and I'm more than happy to answer any questions you have.
Thank you, Victor. That was fantastic. Look, I noticed in your book, one of the credits is actually from Russell Napier, and Russell, a few months back, wrote a paper talking about the fact that central banks are losing control and the shift has gone towards the politicians. Politicians have a different incentive that drives them, that being re-elected. And therefore, we have two scenarios looking at ahead of us. We either print more money or we increase taxes, and he doesn't think given the drive towards politicians being re-elected, the tax scenario is going to win. I don't know if you've read that paper. Can you touch on it? Because I think it's also bringing into account some of the things you touched on, being modern monetary theory, or MMT, which we started to hear about late last year, and I'm a bit shocked at the acceleration of it, to be honest.
Yeah, yeah. I have a great deal of respect for Russell. He's an amazing analyst, and I will recommend anybody reading his stuff because it's excellent. We basically, I agree with Russell on almost everything. In a sense, conventional capitalism is not coming back. Liberal capitalism is not coming back. Central bank balance sheets can never be normalized. Fiscal policies are not coming back. None of those things that we were used to back in 60s and 70s and 80s and 90s ever going to come back. I also completely agree with him that the future funding will come from central banks. It is not going to come from any other source. National debt is nonsense. What is a public sector debt? It's what you public owe to yourself. By eliminating the debt, you're not automatically richer or poorer. Now, if you happen to be borrowing from foreigners, and a lot of emerging markets are in that category, then you live in a different world. But if you borrow essentially from yourself, which is the case, or in other words, essentially mostly in your own currency, and that applies to the United States, that applies to Japan, that applies to China, in many ways that applies to UK, that applies in most cases to Australia, to stronger members of Eurozone. But those countries, they have monetary sovereignty. So if you borrow from yourself, it's your money. You don't owe it to anybody other than to yourself. And by repaying it, you're not automatically better off or worse off. So there is no such thing as national debt. The other thing MMT would argue quite cogently, that you have to have proper institutions of state. So in other words, you can't have your countries being run by Robert Mugabe or Maduro or Kirchner. Again, if you think of the United States for all its imperfections, or if you think of Australia or Canada for all the imperfections, you actually have some solid institutions of state that actually can function even when the government itself sometimes doesn't function. A lot of emerging markets don't have that. And the third thing you need, you can't run into capacity constraints. And that is what Russell Napier is discussing. That as politicians want to get reelected, they'll start spending more and more. They'll start printing more and more money. And it's costless to them. Eventually, economy will run into capacity constraints, just like it did in late 60s, early 1970s. Inflation takes off. And then politicians will be very slow trying to curb it back. And by the time they do, asset classes will just collapse as they try to squeeze inflation out of the system. Now, what he's discussing is capacity constraint. Now, effectively. My disagreement here is that capacity utilization ratios right now are calculated if we are still living in the 19th, 20th century. It's calculated on the basis of factories, machinery, road, humans. When I just mentioned, in some of the countries, over 50% of private sector GDP is now intangible. Intangibles have no capacity constraints. Intangibles can spill very quickly from one industry to another. So inevitably, there is some capacity constraint, but we don't know where it is. It's certainly, we can go on for a long time before we actually reach anything like capacity constraint. So that's the first difference between me and Russell. The other difference is that what I essentially argue, we have a lot of disinflation in our economies. First of all, unlike 60s and 70s, we are 6-7 times more leveraged. Now, leveraging by itself is incredibly disinflationary. Number two, because we're so leveraged, cost of capital is incredibly low, which means zombie companies survive. If you go back to 60s and 70s, usually no more than 2% of companies were zombies, those who couldn't even fund their interest. Today, in every market, it's 10 to 15% of the companies are zombies, which means we don't have clearances of excesses. Companies don't go away the way they should be. Now, not clearing excesses is disinflationary. The third thing, 60s and 70s was not technologically active era. 60s and 70s was about inventiveness, new thing, not about delivering that inventiveness to consumers or businesses, not about innovation. And technology today rapidly disintermediating labor. It's rapidly disintermediating corporates. Corporates are losing control over their products, over their brands, over their distribution systems. That by itself is highly, highly disinflationary. And as I said, intangibles by themselves are highly disinflationary because they are viral, they go everywhere. And so to me, how can you ignite inflation if labor loses pricing power, corporates are losing pricing power, we're highly leveraged, highly financialized, we have zombies everywhere. And by the way, everything is leaching pricing power. How the hell can you ignite inflation? And the answer to me, you can't. Now, if you want to create Zimbabwe, by all means, that can be done in 24 hours, no problem. So you can create Zimbabwe anytime. But, and so the way I look at MMT, instead of saying MMT will create inflation, I'm basically arguing that MMT will reduce disinflation. And a lot of people say, Victor, what's the difference? More inflation, less disinflation? Huge difference. If you assume sustainably high inflation, bonds are bad. At a certain level, around 3 to 4%, equities are bad. And the only thing that works are things like gold, some real assets, but that's about the extent of it. Potentially commodities, although these days it's not clear how commodities are going to work. Now, if you have less disinflation, it's not a bad outcome for bonds. It's not great, but it's not a disaster for bonds. And it's a Goldilocks for equities. And so I'm very much in the latter camp. So unusually for me, when I'm very bearish, usually, I actually finding myself talking about Goldilocks for equities because I believe in more inflation through public sector and less disinflation. To put it the other way, remember we just discussed how we're all rushing to zero. The MMT slows the pace at which we're going down to zero. And therefore, give us more time as societies and economies to adjust to our own irrelevancy. And by giving us more time, hopefully it will lead to less social dislocation and less geopolitical dislocation, which also should have equities. In terms of style, however, value will have somewhat bigger runs, but it's still very much about growth and particularly about thematics. We also like localization themes because we think chronic capitalists will also come, what I prefer to call good chronic capitalism will also come out of the woodwork as we deploy more MMT.
Thank you. Look, Marjorie's just asked, fantastic presentation. Thank you. Do you see a totalitarian future? And is that China's agenda? What about Marxism? Will owning means of production still give power, or is there another model? Thirdly, what about climate change impacts, i.e. impact everyone, everything? So thank you, Marjorie.
Yeah, absolutely. When people say Marxism never works, I say, how do you know? It's never been tried. And so what we perceive as a Marxism is really contortions and convulsions of the 20th century, which has nothing to do with Karl Marx. Even in his own time, when he was still alive, he was dissociating himself from a lot of things that we now regard as Marxist. For Marx, the new age was all about period of very high productivity. And therefore, the slavery of labor will no longer be needed. When people say, oh, terrible, terrible thing, Romans used to sell themselves into slavery. How could they do that? I say, hey, you're doing it every day by coming to the office. You're effectively slave. You have a few more freedoms, but essentially it's a slavery of labor. Society is designed in a way to force you to work if you want to survive. That's the essence of our welfare policies designed to help you to transit from one job to another. That's the essence of our relationship with our employers. And what Marx was basically arguing, that there will be a time of such a high level of productivity that job become irrelevant, work become irrelevant. And it's not just Marx. John Maynard Keynes, in his article on the future for our grandchildren in 1930, highlighted that the biggest challenge for humanity 4 generations from now, which by the way is today, or pretty much 4 generations from now, will be what to do with the time on their hands when technology and compound interest reach the stage that productivity at a level that you don't need to work. Now, if you think of 1980s, 1990s, Peter Drucker, who was one of the founding fathers of management science, as well as people like Kurzweil, were debating exactly the same issue. So for Karl Marx, communism was not what we saw in the 20th century. It was a period of very high productivity rates. And in that respect, that is where we're heading. The only reason our productivity are low right now, because we're warehousing humans in bullshit occupations, pending their final disposal in a way that societies ultimately will find palatable. You're no longer as useful as you used to be, but we can't get rid of you yet. And so the essence is to make this transition from being less useful, being disappointed with your life, to a world of higher productivity. As soon as we stop using you, productivity will mushroom. Instead of 200 basis points, it could go 500, 600 basis points incredibly, incredibly fast. However, the same technology that gives you this benefit could also give you a totalitarian system. Technology is morality neutral. It doesn't have moral backbone. It can be used for evil just as well as it can be used for good. And so the question is, how do we actually reach the stage? How we structure it in a way that we don't create totalitarian systems. We don't create 1984. We don't create, bread and circuses. How can we reach that stage? Because China is the first example, I think, of proving that you don't need to be free to be successful, to be prosperous, and as I said, potentially perhaps even free. And China within a decade or two might be able to prove it. But it's not just China. A lot of other countries will be imitating a very similar model. And that's why I look at the policies, things like basic income guarantees, things like what are we going to do with the regulatory and anti-monopolistic policies, things like education and skilling policies, things like support for least developed countries, the Marshall Plan. We need to have a plethora of policies that will leave us as much freedom as we can tolerate, so to speak. There will be less freedom, no question about it. There will be less freedom. We already have less freedom than we used to. There will be less. It's just a question, can we find a happy medium between the two? And my hope is that we can. And that's essentially, in a nutshell, the fight between Anglosphere and a Sinosphere that is occurring today. If you distill it to that basic point, that's what's occurring as we discuss it today. Climate is different, but also interrelated. This is a legacy, as I said, of baby boomers, and baby boomers striving for wealth and perpetual growth. And climate, the way I look at it, and the good news is that millennials and Z generations share a lot more than my generations would ever share. They confide into each other a lot more than I would have confided even to my friends. They exchange things a lot more easily than I would have exchanged things. They ask for guardrails and support. They hate being told off in many ways. They hate when you confront negative things. Now, what that basically implies is that the pressure to grow, irrespective of the consequences, is already diminishing. The pressure to redistribute is already rising. There is no question that if you're 0.1% of the population, you're going to be okay. But if you're between 0.1 and 1, you're going to give up a lot of your money that you have. And the question you would need to ask yourself, do you want to live in a civilized society, or do you want to hang from the lamppost, to be crude about it? So that's your question. And if the answer, I want to live in a civilized society and I want to have environment the way I still can live, then the answer is that you need to give up. So taxation system is going to change. Income distribution system is going to change. I think within 10 years, you will find that our new Carl Icahn or Mike Milken, instead of penalizing companies for not growing profits, and instead of penalizing companies for not breaking up their assets, will be penalizing companies because they have too much share buybacks, penalizing companies because their CEOs' compensation levels are too high. They'll be penalizing companies because companies polluting. They'll be penalizing companies for that they don't pay tax. Not paying tax will be bad paying tax will be good. So you can see how US Business Roundtable, for example, in August 2019, already changed the definition of corporates. Gordon Gekko is dead. Sort of societal values are in. And so you can see between generational change, societal attitudes, changes in the corporate structure. Because remember, corporates reflect society. When Gordon Gekko was popular, that's what companies were doing. If Gordon Gekko is not popular, companies will have to change what they do. That also explains why ESG portfolios becoming so popular. ESG portfolio managers in many ways, and I don't need to insult them, have no idea what to select yet because there is no established criteria what actually constitute ESG. But the intuitive feeling what it is absolutely correct. It is environment, it is society, it is fairness, it's equality, it's governance. It's a very, you just have difficulty quantifying how do you exactly create portfolio on the back of that. But the ideas are right, and those ideas actually are going to get stronger.
Thank you. Stuart's asking, what role, if any, do cryptocurrencies play going forward?
Yeah, it's a great question. A lot of people said, Victor, in your thematic portfolios that are run, you don't have blockchains and you don't have cryptocurrencies. Why not? And my argument is very simple, that there's no question blockchain will change how we do things. There's no question that transaction costs, both for corporates and banks, are going to collapse. There is no question that banks as we know them today will not exist 10 years from now. It's going to be completely unrecognizable to what they are today. We all understand that. We also all understand that the currencies as such in a world where capital is worth nothing also is going to change and how the currencies function. The problem I have right now is what exactly will take their place and how. So when people say, do you like Bitcoin or something else? I said, I have no idea. The way I compare it is to the cars of early 1900s. In 1900, only 2,000 cars were produced. Sorry, 10,000 cars by 2,000 car makers. Some had 3 wheels, some had 4 wheels, some had combustion engine, some have electrical. By the way, half of them were electrical. People had no idea. If you invested in those companies, you would have lost money. By 1920, there was only 200 car makers left. They were producing over 2 million cars. We knew there's going to be 4 wheels, black car, boxy, clutch, the whole works. If you invested any of those 200 car makers in 1920, you would have made money. So the way I look at cryptocurrencies and blockchain, it's a bit like investing in the cars in 1900. I have no idea. I know it's important. I know it's going to be very important, but I don't know how it's going to change, because there is no question that gold cannot replace monetary system. That's not possible, because gold will not allow you the type of leveraging and financialization, which is the oxygen of the system, the way we run. So gold cannot replace it. Can cryptocurrencies replace it? The answer is yes. And then the question, who controls the cryptocurrencies? And who is responsible for cryptocurrencies? And how do you safeguard it? Will it be one cryptocurrency or many? I personally think not a single cryptocurrency will take over. I don't think there's going to be a global currencies. I think it's going to be blocks and local exchanges. I think your pet shop will have a cryptocurrency. I think the idea of having a global currency or global measure of wealth and exchange will just go away. And eventually none of that will exist. But today, part of the reason I don't have blockchains in my portfolio and I don't have cryptos, I have no idea. I think right now it's a space for venture capitalists, not for people who manage their money against benchmarks.
Right, look, in the interest of time, I was going to ask one last question because we are getting close to 5 o'clock our time. But Mark's touching on it, we're moving, just shifting a little bit here, he's shifting into Hong Kong and the new controls by China over Hong Kong. Wanting to know if you think that's been priced into the markets yet, and will it have any effect? I think it probably will long term, but interested in your view on H shares versus A shares. You better explain to people what an A share is and an H share too.
Yeah, basically what we're referring to, H shares are Chinese companies listed in Hong Kong, A shares are Chinese companies listed in China. Hang Seng Index essentially reflects China. If you just want to invest in Hong Kong, there is an index, MSCI Hong Kong, which essentially mostly reflects just Hong Kong domestic plus Macau casinos. So when people say, confidence in Hong Kong, Hang Seng gone up, that's confidence in China. That is not confidence in Hong Kong. So that there has to be a little bit of a sort of a technical difference between that. Now, my personal view is that if I think of China, there is only one emerging market that will make it, and that is China. If I think of emerging market universe, it has no right to exist. The whole essence of emerging market universe is faster growth rates and convergence. That premise is predicated on ability to grow by leveraging global demand through trade, globalization, manufacturing. All of those windows of opportunities are closing very rapidly for all emerging markets. And those opportunities only rise now and again. Between 1850s and 1913, that was the opportunity for United States and Germany to do that. From late 70s, early 80s, that was the opportunity for Japan, Korea, Taiwan, China to do that. And parts of Southeast Asia like Malaysia, Thailand. A lot of countries don't utilize this opportunity while it's available. I mean, classic example is Latin America. They decided not to. Or India, they were lost in a tunnel for all of those decades. And so opportunities for EMs are disappearing. And so emerging markets, a lot of them will go back to the Stone Age. Because they have too much of things you don't want and too little of things you do want. They have too much labor, particularly young people. And remember, demographic now works in the opposite direction. The more people you have, the worse you are, particularly if they're young, because you're no longer relevant. And at the same time, they have very little of intangible capital that we have discussed, and very little of technology. So the only way emerging markets can survive is, number one, they need to have a very large domestic economy, which a lot of them don't have because they can't leverage global. Number two, they need to leverage their fiscal and MMT policies. Again, most emerging markets can't do that. Number three, they need to address domestic inefficiencies. That's your non-tradable sector. So I usually say, what's the difference between Australia and Indonesia? They sell the same stuff, coal, copper. Okay, Australians will argue our coal is better, but whatever. It's pretty much the same stuff. So what is the difference? Why Australia has high income level, low inequality, while Indonesia is the other way around? The answer is Australia's non-tradable sectors: retail trade, wholesale trade, construction, utilities, financial services, domestic manufacturing. In Australia, it's highly efficient. In Indonesia, it's a cesspit of corruption, nepotism, monopolistic rents. It's everything to do with the usage of land, labor. So if you were to argue that you can't really address domestic sectors because the elite will reject it for a very long time, and if you were to argue most emerging markets don't have sufficient size domestic market, and if you also were to argue that a lot of them can't utilize their fiscal and MMT policies, then the only answer for those countries is Marshall Plan. And that's why I kept emphasizing that Marshall Plan becomes the only way forward. Now, if you think of emerging market universe, only China ticks all the boxes. Nobody else. Assuming you don't regard Korea, Taiwan as emerging. So only China ticks all the boxes. The only problem is, I think at some point in time, global fund managers will be neither allowed nor want to invest in China. And that becomes a big, big question mark. More and more Chinese companies and sectors will be blacklisted, not by the State Department in the United States, but by ESG, by societal norms, by the trustees of your fund managers. The way I basically say, let's say 5 years from now, you go to your trustee and say, I really like China, I want to increase my weighting. The trustee will say, you sure about that? Am I going to wake up on Monday morning and read in Financial Times that company I invested abusing people or something? Are you sure you want to do that? And so what's going to happen, almost inevitably, fund managers will start self-censoring themselves. They will start second guessing as to where they should be and where they shouldn't be. That by itself will reduce desirability of doing it. But if you assume that that view I have, that the rupture between Anglosphere and Sinosphere is permanent, it will never be healed and in fact will widen as we go forward. If you take that view, then a lot of global fund managers might not be willing to or able to invest. But putting that to aside, if you just forget what China does and how China does it, and just look at China, it's got more themes than any other sector, any other country. It's got more small cap, large cap, mid caps that you want to play, better ideas that you want to play than any other than the rest of the emerging market universe combined, plus more.
Victor, we've gone over time, but thank you very much. We really appreciate it. And you realise that you're a very busy man, but spending some time talking to our clients, it's very, very much appreciated. Thank you enormously.
Well, thank you, Will. And thank you, everybody, for participating.
When we send out a recording to you, I'll also put the link for the book again. So that was with the invitation. So just for the attendees, I'll enclose that again if you are at all interested in purchasing a copy on Amazon. Thank you. Enjoy the rest of your day. And for those in Australia, enjoy your evening. Thank you.
Thank you. Bye-bye.
Bye-bye.